Open a ZERODHA account. Chapter 7. Bear Put Spread. 7.1 Spreads versus Naked Positions. Over the last 5 chapters we've discussed various multi-leg bullish strategies. These strategies range to suit an assortment of market outlook, from an outrightly bullish market outlook to moderately bullish market outlook. Reading through the last 5 chapters, you must have realized that most professional options traders prefer initiating a spread strategy versus taking on naked option positions. No doubt, spreads tend to shrink the overall profitability, but at the same time spreads give you a greater visibility on risk. Professional traders value risk visibility more than the profits. In simple words, it's a much better deal to take on smaller profits as long as you know what would be your maximum loss under worst-case scenarios. Another interesting aspect of spreads is that invariably there is some sort of financing involved, wherein the purchase of an option is funded by the sale of another option. In fact, financing is one of the key aspects that differentiate a spread versus a normal naked directional position. Over the next few chapters we will discuss strategies which you can deploy when your outlook ranges from moderately bearish to outrightly bearish. The composition of these strategies is similar to the bullish strategies that we discussed earlier in the module. The first bearish strategy we will look into is the bear put spread, which, as you may have guessed, is the equivalent of the bull call spread. 7.2 Strategy Notes. Similar to the bull call spread, the bear put spread is quite easy to implement. One would implement a bear put spread when the market outlook is moderately bearish, i.e. you expect the market to go down in the near term while at the same time you don't expect it to go down much. If I were to quantify moderately bearish, a 4 to 5% correction would be apt. By invoking a bear put spread, one would make a modest gain if the markets go down as expected, but on the other hand, if the markets were to go up, the trader will end up with a limited loss. A conservative trader, read as risk-averse trader, would implement bear put spread strategy by simultaneously buying an in-the-money put option, selling an out-of-the-money put option. There is no compulsion that the bear put spread has to be created with an ITM and OTM option. The bear put spread can be created employing any 2 put options. The choice of strike depends on the aggressiveness of the trade. However, do note that both the options should belong to the same expiry and same underlying. To understand the implementation better, let's take up an example and see how the strategy behaves under different scenarios. As of today, Nifty is at 7,485. This would make 7,600 pay in the money and 7,400 pay out of the money. The bear put spread would require one to sell 7,400 pay. The premium received from the sale would partially finance the purchase of the 7,600 pay. The premium paid PP for the 7,600 pay is 165 rupees. And the premium received PR for the 7,400 pay is 73 rupees per. The net debit for this transaction would be 73 to 165 equals minus 92. To understand how the payoff of the strategy works under different expiry circumstances, we need to consider different scenarios. Please do bear in mind the payoff is upon expiry, which means to say that the trader is expected to hold these positions till expiry. Scenario 1: market expires at 7,800 above long put option, i.e. 7,600. This is a case where the market has gone up as opposed to the expectation that it would go down. At 7,800, both the put option, i.e. 7,600 and 7,400, would not have any intrinsic value. Hence they would expire worthless. The premium paid for 7,600 pay, i.e. 165 rupees, would go to zero. Hence we retain nothing. The premium received for 7,400 pay, i.e. 73 rupees, would be retained entirely. Hence at 7,800, we would lose 165 rupees on one hand, but this would be partially offset by the premium received, i.e. 73 rupees. The overall loss would be minus 165 plus 73 equals minus 92. Do note the VE sign associated with 165 indicates that this is a money outflow from the account, and the plus VE sign associated with 73 indicates that the money is received into the account. Also, the net loss of 92 is equivalent to the net debit of the strategy. Scenario 2, market expired at 7,600 at long put option. In this scenario, we assume the market expires at 7,600, where we have purchased a put option. But then, at 7,600, both 7,600 and 7,400 pay would expire worthless, similar to scenario 1, resulting in a loss of minus 92. Scenario 3, market expires at 7,508, break-even. 7,508 is halfway through 7,600 and 7,400. And as you may have guessed, I've picked 7,508 specifically to showcase that the strategy neither makes money nor loses any money at this specific point. The 7,600 pay would have an intrinsic value equivalent to max 7600,7508, which is 92. Since we have paid 165 rupees as premium for the 7,600 pay, some of the premium paid would be recovered. That would be 165 to 92 equals 73. Which means to say the net loss on 7,600 pay at this stage would be 73 rupees and not 165 rupees. The 7,400 pay would expire worthless. Hence we get to retain the entire premium of 73 rupees. So on hand we make 73, 7,400 pay, and on the other we lose 73, 7,600 pay, resulting in a no loss no profit situation. Hence, 7,508 would be the break-even point for this strategy. Scenario 4, market expires at 7,400 at short put option. This is an interesting level. Do recall when we initiated the position, the spot was at 7,485. And now the market has gone down as expected. At this point, both the options would have interesting outcomes. The 7,600 pay would have an intrinsic value equivalent to max 7600,7400, which is 200. We have paid a premium of 165 rupees, which would be recovered from the intrinsic value of 200 rupees. Hence, after compensating for the premium paid, one would retain 35 rupees per. The 7,400 pay would expire worthless. Hence, the entire premium of 73 rupees would be retained. The net profit at this level would be 35 plus 73 equals 108. The net payoff from the strategy is in line with the overall expectation from the strategy, i.e. the trader gets to make a modest profit when the market goes down. Scenario 5, market expires at 7,200 below the short put option. This is again an interesting level as both the options would have an intrinsic value. Let's figure out how the numbers add up. The 7,600 pay would have an intrinsic value equivalent to max 7600,7200, which is 400. We have paid a premium of 165 rupees, which would be recovered from the intrinsic value of 400 rupees. Hence, after compensating for the premium paid, one would retain 235 rupees per. The 7,400 pay would have an intrinsic value equivalent to max 7400,7200, which is 200. We received a premium of 73 rupees. However, we will have to let go of the premium and bear a loss over and above 73. This would be 200 to 73 equals 127. On one hand, we make a profit of 235 rupees and on the other we lose 127. Therefore, the net payoff of the strategy would be 235 to 127 equals 108. Summarizing all the scenarios, I've put up the payoff values directly after considering the premiums. Market expiry long put 7,600 _IV short put 7,400 _IV net payoff 78000092 76000092 75089200 7200 400 200 plus 108. Denote. The net payoff from the strategy is in line with the overall expectation from the strategy, i.e. the trader gets to make a modest profit when the market goes down, while at the same time the losses are kept in case the market goes up. Have a look at the table below. The table below shows the strategy payoff at different expiry levels. The losses are capped to 92 when markets go up, and the profits are capped to 108 when markets go down. 7.3 Strategy Critical Levels. From the above discussed scenarios, we can generalize a few things. Strategy makes a loss if the spot moves above the break-even point, and makes a profit below the break-even point. Both the profits and loss are capped. Spread is difference between the two strike prices. In this example, spread would be 7600,7400 equals 200. Net debit equals premium paid, premium received. 165 to 73 equals 92. Break even equals higher strike, net debit. 7,692 equals 7,508. Max profit equals spread, net debit. 200 to 92 equals 108. Max loss equals net debit. 92. You can note all these critical points in the strategy payoff diagram. 7.4 Quick note on delta. This is something I missed talking about in the earlier chapters. But it's better late than never, smiley face. Whenever you implement an option strategy, always add up the deltas. I used the B&S calculator to calculate the deltas. The delta of 7,600 pay is minus 0.618. The delta of 7,400 pay is 0.342. The negative sign indicates that the put option premium will go down if the markets go up, and premium gains value if the markets go down. But do note, we have written the 7,400 pay. Hence the delta would be minus 0.342 plus 0.342. Now, since deltas are additive in nature, we can add up the deltas to give the combined delta of the position. In this case, it would be minus 0.618 plus 0.342 equals 0.276. This means the strategy has an overall delta of 0.276, and the V indicates that the premiums will go up if the markets go down. Similarly, you can add up the deltas of other strategies we've discussed earlier: bull call spread, call ratio, back spread, etc., and you will realize they all have a positive delta indicating that the strategy is bullish. When you have more than two option legs, it gets really difficult to estimate the overall bias of the strategy, whether the strategy is bullish or bearish. In such cases, you can quickly add up the deltas to know the bias. Further, if in case the delta is dead to zero, then it means that the strategy is not really biased to any direction. Such strategies are called delta neutral. We will eventually discuss these strategies at a later point in this module. Also, you may be interested to know that while the delta neutral strategies are immune to markets' directional move, they react to changes in volatility in time. Hence, these are also sometimes called volatility-based strategies. 7.5 Strike selection and effective volatility. The strike selection for a bear put spread is very similar to the strike selection methodology of a bull call spread. I hope you are familiar with the first half of the series' and second half of the series' methodology. If not, I'd suggest you to kindly read through section 2.3. Have a look at the graph below. If we are in the first half of the series, ample time to expiry, and we expect the market to go down by about 4% from present levels, choose the following strikes to create the spread. Expect 4% move to happen within higher strike, lower strike. Refer graph on 5 days FAR OTM top left, 15 days ATM slightly OTM top right, 25 days ATM OTM bottom left, at expiry ATM OTM bottom right. Now, assuming we are in the second half of the series, selecting the following strikes to create the spread would make sense. Expect 4% move to happen within higher strike, lower strike. Refer graph on same day, even specific OTM top left, 5 days OTM top right, 10 days OTM bottom left, at expiry OTM bottom right. I hope you will find the above two tables useful while selecting the strikes for the bear put spread. We will now shift our focus on the effective volatility on the bear put spread. Have a look at the following image. The graph above explains how the premium varies with respect to variation in volatility in time. The blue line suggests that the cost of the strategy does not vary much with the increase in volatility when there is ample time to expiry, 30 days. The green line suggests that the cost of the strategy varies moderately with the increase in volatility when there is about 15 days to expiry. The red line suggests that the cost of the strategy varies significantly with the increase in volatility when there is about 5 days to expiry. From these graphs, it is clear that one should not really be worried about the changes in the volatility when there is ample time to expiry. However, one should have a view on volatility between midway and expiry of the series. It is advisable to take the bear put spread only when the volatility is expected to increase. Alternatively, if you expect the volatility to decrease, it's best to avoid the strategy. Download the Bear Put Spread Excel. Key takeaways from this chapter. Spread offers visibility on risk but at the same time shrinks the reward. When you create a spread, the proceeds from the sale of an option offsets the purchase of an option. Bear put spread is best invoked when you are moderately bearish on the markets. Both the profits and losses are capped. Classic bear put spread involves simultaneously purchasing ITM put options and selling OTM put options. Bear put spread usually results in a net debit. Net debit equals premium paid, premium received. Break-even equals higher strike, net debit. Max profit equals spread, net debit. Max loss equals net debit. Select strikes based on the time to expiry. Implement the strategy only when you expect the volatility to increase, especially in the second half of the series. 34 responses to bear puts. Open a ZERODHA account. Chapter 8. Bear Call Spread. 8.1 Choosing calls over puts. Similar to the bear put spread, the bear call spread is a two-leg option strategy invoked when the view on the market is moderately bearish. The bear call spread is similar to the bear put spread in terms of the payoff structure. However, there are a few differences in terms of strategy execution and strike selection. The bear call spread involves creating a spread by employing call options rather than put options, as is the case in bear put spread. You may have a fundamental question at this stage when the payoffs from both bear put spread and bear call spread are similar. Why should one choose a bear call spread over a bear put spread? Well, this really depends on how attractive the premiums are. While the bear put spread is executed for a debit, the bear call spread is executed for a credit. So if you are at a point in the market where the markets have rallied considerably, therefore call premiums have swelled, the volatility is favorable, ample time to expiry, and you have a moderately bearish outlook going forward, then it makes sense to invoke a bear call spread for a net credit as opposed to invoking a bear put spread for a net debit. Personally, I do prefer strategies which offer net credit rather than strategies which offer net debit. 8.2 Strategy Notes. The bear call spread is a two-leg spread strategy traditionally involving ITM and OTM call options. However, you can create the spread using other strikes as well. Do remember, the higher the difference between the two selected strikes, spread, larger is the profit potential. To implement the bear call spread, buy one OTM call option, leg 1. Sell one ITM call option, leg 2. Ensure all strikes belong to the same expiry series. Each leg involves the same number of options. Let us take up example to understand this better. Date, February 2016. Outlook, moderately bearish. Nifty spot 7,222. Bear call spread. Trade setup. Buy 7,400 CE by paying 38 rupees per as premium. Do note this is an OTM option. Since money is going out of my account, this is a debit transaction. Sell 7,100 CE and receive 136 rupees per as premium. Do note this is an ITM option. Since I receive money, this is a credit transaction. The net cash flow is the difference between the debit and credit, i.e. 136 to 38 equals plus 98. Since this is a positive cash flow, there is a net credit to my account. Generally speaking, in a bear call spread there is always a net credit. Hence the bear call spread is also referred to as a credit spread. After we initiate the trade, the market can move in any direction and expiry at any level. Therefore, let us take up a few scenarios to get a sense of what would happen to the bear put spread for different levels of expiry. Scenario 1: market expires at 7,500 above the long call. At 7,500. Both the call options would have an intrinsic value and hence they both would expire in the money. 7,400 CE would have an intrinsic value of 100. Since we have paid a premium of 38 rupees, we would be in a profit of 100 to 38 equals 62. 7100 CE would have an intrinsic value of 400. Since we have sold this option at raw 0.136, we would incur a loss of 400 to 136 equals minus 264. Net loss would be minus 264 plus 62 equals 202. Scenario 2, market expires at 7,400 at the long call. At 7,400. The 7100 CE would have an intrinsic value and hence would expire in the money. The 7400 CE would expire worthless. 7400 CE would expire worthless. Hence, the entire premium of 38 rupees would be written off as a loss. 7100 CE would have an intrinsic value of 300. Since we have sold this option at raw 0.136, we would incur a loss of 300 to 136 equals minus 164. Net loss would be minus 164 minus 38 equals 202. Denote: the loss at 7,400 is similar to the loss at 7,500, pointing to the fact that above a certain point, loss is capped to 202. Scenario 3, market expires at 7,198, break even. At 7,198. The trade neither makes money or loses money. Hence this is considered a break-even point. Let us see how the numbers play out here. At 7,198. The 7100 CE would expire with an intrinsic value of 98. Since we have sold the option at 136 rupees, we get to retain a portion of the premium, i.e. 136 to 98 equals plus 38. 7400 CE would expire worthless. Hence we will lose the premium paid, i.e. 38. Net payoff would minus 38 plus 38 equals 0. This clearly indicates that the strategy neither makes money or loses money at 7,198. Scenario 4, market expires at 7,100 at the short call. At 7,100. Both the call options would expire worthless. Hence it would be out of the money. 7,400 would not have any value. Hence the premium paid would be a complete loss, i.e. 38 rupees. 7,100 will also not have any intrinsic value. Hence the entire premium received, i.e. 136 rupees, would be retained back. Net profit would be 136 to 38 equals 98. Clearly, as and when the market falls, the strategy makes a profit. Scenario 5, market expires at 7,000 below the short call. This scenario tests the profitability of the strategy when the market falls further. At 7,000. Both the call options would expire worthless, while we treat the premium paid for 7,400 CE, i.e. 38 rupees, as a loss. We will retain the entire premium received for 7,100 CE, i.e. 136 rupees, as a profit. Hence the net profit from the strategy would be 136 to 38 equals 98. Clearly, as and when the market falls, the strategy tends to make money, but it is capped to 98 rupees. Here is the payoff for the strategy at different expiries. These payoffs can be plotted to get the graph of the strategy payoff. As you can observe, the payoff is similar to a bear-put spread where both the profits under best-case scenario and losses under worst-case scenario is predefined. 8.3 Strategy Generalization. Going by the above path, we can generalize the key trigger points for the strategy. Spread equals difference between the strikes. 7400, 7100 equals 300. Net credit equals premium received, premium paid. 136 to 38 equals 98. Break even equals lower strike plus net credit. 7,100 plus 98 equals 7,198. Max profit equals net credit. Max loss equals spread, net credit. 300 to 98 equals 202. At this stage, we can add up the deltas to get the overall position delta to know the strategy's sensitivity to the directional movement. From the BS calculator, I got the delta values as follows. 7400 says OTM option and has a delta of plus 0.32. 7100 says ITM option and has a delta of plus 0.89. Since we are short 7100 CE, the delta is plus 0.89 equals minus 0.89. Overall position delta is equals plus 0.32 plus minus 0.89 equals minus 0.57. The delta of the strategy is negative, and it indicates that the strategy makes money when the underlying goes down, and makes a loss when the underlying goes up. 8.4 Strike selection and impact of volatility. The following images help us identify the best call option strikes to choose, given the time to expiry. We have discussed the split up of time frame first and second half of the series several times before. Hence, for this reason, I will just post the graphs and the summary table. Strikes to select when we are in the first half of the series. Expect 4% move to happen within higher strike, lower strike. Refer graph on 5 days for OTM ATM plus 2 strikes, top left. 15 days for OTM ATM plus 2 strikes, top right. 25 days OTM ATM plus 1 strike, bottom left. At expiry OTM ATM, bottom right. Strikes to select when we are in the second half of the series. Expect 4% move to happen within higher strike, lower strike. Refer graph on 5 days for OTM, top left. 15 days for OTM, slightly OTM, top right. 25 days slightly OTM ATM, bottom left. At expiry OTM ATM, ITM, bottom right. The following graph talks about the variation in strategy cost with respect to changes in the volatility. The graph above explains how the premium varies with respect to variation in volatility in time. The blue line suggests that the cost of the strategy does not vary much with the increase in volatility when there is ample time to expiry, 30 days. The green line suggests that the cost of the strategy varies moderately with the increase in volatility when there is about 15 days to expiry. The red line suggests that the cost of the strategy varies significantly with the increase in volatility when there is about 5 days to expiry. From these graphs, it is clear that one should not really be worried about the changes in the volatility when there is ample time to expiry. However, one should have a view on volatility between midway and expiry of the series. It is advisable to take the bear call spread only when the volatility is expected to increase. Alternatively, if you expect the volatility to decrease, it's best to avoid the strategy. Download the Bear Call Spread Excel. Key takeaways from this chapter. Bear call spread is best invoked when you are moderately bearish on the markets. You choose a bear call spread over a bear put spread when the call option premiums are more attractive than put options. Both the profits and losses are capped. Classic bear call spread involves simultaneously purchasing OTM call options and selling ITM call options. Bear call spread usually results in a net credit. In fact, this is another key reason to invoke a bear call spread versus a bear put spread. Net credit equals premium received, premium paid. Break-even equals lower strike plus net credit. Max profit equals net credit. Max loss equals spread, net credit. Select strikes based on the time to expiry. Implement the strategy only when you expect the volatility to increase, especially in the second half of the series. Open a ZERODHA account. Chapter 9. Put ratio back spread. 9.1 Background. We discussed the call ratio back spread strategy extensively in Chapter 4 of this module. The put ratio back spread is similar except that the trader invokes this when he is bearish on the market or stock. At a broad level, this is what you will experience when you implement the put ratio back spread. Unlimited profit if the market goes down. Limited profit if market goes up. A predefined loss if the market stays within a range. In simpler words, you make money as long as the market moves in either direction. Of course, the strategy is more favorable if market goes down. Usually, the put ratio back spread is deployed for a net credit, meaning money flows into your account as soon as you execute put ratio back spread. The net credit is what you make if the market goes up, as opposed to your expectation, i.e. market going down. On the other hand, if the market indeed goes down, then you stand to make an unlimited profit. I suppose this should also explain why the put ratio back spread is better than buying a plain vanilla put option. 9.2 Strategy Notes. The put ratio back spread is a three-leg option strategy as it involves buying 2 OTM put options and selling 1 ITM put option. This is the classic 2-to-1 combo. In fact, the put ratio back spread has to be executed in the 2-to-1 ratio, meaning 2 options bought for every 1 option sold, or 3 options bought for every 2 options sold, so on and so forth. Let's take an example. Nifty spot is at 7,506 and you expect Nifty to hit 7,000 by the end of expiry. This is clearly a bearish expectation. To implement the put ratio back spread, sell 1 lot of 7,500 pay ITM. Buy 2 lots of 7,200 pay OTM. Make sure the put options belong to the same expiry, belong to the same underlying. The ratio is maintained. The trade setup looks like this. 7,500 pay. 1 lot short. The premium received for this is 134 rupees per 7,200 pay. 2 lots long. The premium paid is 46 rupees per lot. So 92 rupees for 2 lots. Net cash flow is equals premium received, premium paid, i.e. 134 to 92 equals 42 net credit. With these trades, the put ratio back spread is executed. Let us check what would happen to the overall cash flow of the strategies at different levels of expiry. Do note we need to evaluate the strategy payoff at various levels of expiry, as the strategy payoff is quite versatile. Scenario 1: market expires at 7,600 above the ITM option. At 7,600, both the put options would expire worthless. The intrinsic value of options and the eventual strategy payoff is as below. 7,200 pay would expire worthless. Since we are long 2 lots of this option at 46 rupees per lot, we would lose the entire premium of 92 rupees paid. 7,500 pay would also expire worthless. But we have written this option and received a premium of 134 rupees, which in this case can be retained back. The net payoff from the strategy is 134 to 92 equals 42. Denote: the net payoff of the strategy at 7,600 higher than the ITM strike is equivalent to the net credit. Scenario 2: market expires at 7,500 at the higher strike, i.e. the ITM option. At 7,500 both the options would have no intrinsic value. Hence they both would expire worthless. Hence the payoff would be similar to the payoff we discussed at 7,600. Hence the net strategy payoff would be equal to 42 rupees net credit. In fact, as you may have guessed, the payoff of the strategy at any point above 7,500 is equal to the net credit. Scenario 3: market expires at 7,458 higher break-even. Like in the call ratio back spread strategy, the put ratio back spread 2 has two break-even points, i.e. the upper break-even and the lower break-even point. 7,458 marks the upper break-even level. Of course, we will discuss how we arrived at the upper break-even point a little later in the chapter. At 7,458, the 7,500 pay will have an intrinsic value. As you may recall, the put option intrinsic value can be calculated as max strike spot 0, i.e. max 7,500,7458 0, hence 42. Since we have sold 7,500 pay at 134, we will lose a portion of the premium received and retain the rest. Hence the payoff would be 134 to 42 equals 92. The 7,200 pay will not have any intrinsic value. Hence, the entire premium paid, i.e. 92, is lost. So on one hand we made 92 on the 7,500 pay, and on the other we would lose 92 on the 7,200 pay, resulting in no loss, no gain. Thus, 7,458 marks as one of the break-even points. Scenario 4: market expires at 7,200, point of maximum pain. This is the point at which the strategy causes maximum pain. Let us figure out why. At 7,200, 7,500 pay would have an intrinsic value of 307,500,7200. Since we have sold this option and received a premium of 134 rupees, we would lose the entire premium received and more. The payoff on this would be 134 to 300 equals 166. 7,200 pay would expire worthless as it has no intrinsic value. Hence the entire premium paid of 92 rupees would be lost. The net strategy payoff would be minus 166. 92 equals 258. This is a point where both the options would turn against us. Hence is considered as the point of maximum pain. Scenario 5: market expires at 6,942, lower break-even. At 6,942, both the options would have an intrinsic value. However, this is the lower break-even point. Let's figure out how this works. At 6,942, 7,500 pay will have an intrinsic value equivalent of 7,500,6942 equals 558. Since have sold this option at 134, the payoff would be 134 to 558 equals 424. The 7,200 pay will also have an intrinsic value equivalent of 7,200,6942 equals 258 per lot. Since we are long two lots, the intrinsic value adds up to 516. We have initially paid a premium of 92 rupees, both lots included. Hence this needs to be deducted to arrive at the payoff would be 516 to 92 equals plus 424. So on one hand we make 424 on the 7,200 pay, and on the other we would lose 424 on the 7,500 pay, resulting in no loss, no gain. Thus, 6,942 marks is one of the break-even points. Scenario 6: market expires at 6,800 below the lower strike price. Remember, the put ratio back spread is a bearish strategy. It is supposed to make money once the market goes below the lower break-even point. So let's understand how the payoff behaves at a point lower than the lower break-even point. At 6,800, 7,500 pay will have an intrinsic value of 700, and since we are short 7,500 PE at 134, we would lose 134 to 700 equals 566. 7,200 pay will have an intrinsic value of 400. Since we are long 2 lots, the intrinsic value would be 800. Premium paid for 2 lots is 92 rupees. Hence, after adjusting for the premium paid, we get to make 800 to 92 equals plus 708. Net strategy payoff would be 708 to 566 equals plus 142. Likewise, you can evaluate the strategy payoff at different levels of market expiry, and you will realize that the profits are uncapped as long as the market continues to slide. The following table showcases the same. Plotting the different payoff points gives us the strategy payoff graph. Clearly from the graph above, we can conclude, if markets go down, then the profits are unlimited. There are 2 break-even points. The point at which maximum loss occurs is at 7,200. If markets goes up, then the profits are limited. 9.3 Strategy Generalization. We can generalize the key strategy levels as below. Spread equals higher strike, lower strike. 7500, 7200 equals 300. Max loss equals spread, net credit. 300 to 42 equals 258. Max loss occurs at equals lower strike price. Lower break-even point equals lower strike, max loss. 7200258 equals 6,942. Upper break-even point equals lower strike plus max loss. 7,200 plus 258 equals 7,458. 9.4 Delta. Strike selection and effective volatility. As we know, the strategy gets more profitable as and when the market falls. In other words, this is a directional strategy, profitable when markets go down, and therefore the delta at overall strategy level should reflect this. Let us do the math to figure this out. 7,500 pay as ITM option. Delta is 0.55. However, since we have written the option, the delta is minus 0.55 equals plus 0.55. 7,200 pay as OTM has a delta of 0.29. Remember, we are long 2 lots here. The overall position delta would be plus 0.55 plus minus 0.29 plus minus 0.29 equals 0.03. The non-zero delta value clearly indicates that the strategy is sensitive to the directional movement, although negligible. The negative sign indicates that the strategy makes money when the market goes down. As far as the strikes are concerned, I'd suggest you stick to the classic combination of ITM and OTM options. Remember, the trade needs to be executed for a net credit. Do not initiate this strategy if there is a net outflow of cash at the time of execution. Let's look at the variation in volatility and its effect on the strategy. There are 3 colored lines depicting the change of premium value versus change in volatility. These lines help us understand the effect of increase in volatility on the strategy, keeping time to expiry in perspective. Blue line. This line suggests that an increase in volatility when there is ample time to expiry 30 days is beneficial for the put ratio back spread. As we can see, the strategy payoff increases from -57 to +10 when the volatility increased from 15% to 30%. Clearly, this means that when there is ample time to expiry. Besides being right on the direction of stock index, you also need to have a view on volatility. For this reason, even though I'm bearish on this stock, I would be a bit hesitant to deploy this strategy at the start of the series if the volatility is on the higher side, say more than double of the usual volatility reading. Green line. This line suggests that an increase in volatility when there are about 15 days time to expiry is beneficial, although not as much as in the previous case. As we can see, the strategy payoff increases from -77 to -47 when the volatility increased from 15% to 30%. Red line. Clearly, increase in volatility when we have a few days to expiry does not have much impact on the premium value. This means when you are close to expiry, you only need to worry about the directional movement and need not really worry much about the variation in volatility. Download the Put Ratio Back Spread Excel. Key takeaways from this chapter. The put ratio back spread is best executed when your outlook on the stock index is bearish. The strategy requires you to sell 1 ATM pay and buy 2 OTM pay. And this is to be executed in the same ratio, i.e. for every 1 option sold, 2 options have to be purchased. The strategy is usually executed for a net credit. The strategy makes limited money if the stock price goes up, and unlimited profit when the stock price goes down. There are 2 break-even points, lower break-even and upper break-even. Spread equals higher strike, lower strike. Net credit equals premium received for higher strike 2 asterisk premium paid for lower strike. Max loss equals spread, net credit. Max loss occurs at equals lower strike. The payoff when market goes up equals net credit. Lower break-even equals lower strike, max loss. Upper break-even equals lower strike plus max loss. Irrespective of the time to expiry, opt for ITM and OTM strike combination. Increase in volatility is good for this strategy when there is more time to expiry. Open a ZERODHA account. Chapter 10. The Long Straddle. 10.1 The Directional Dilemma. How many times have you been in a situation wherein you take a trade after much conviction, either long or short, and right after you initiate the trade the market moves just the other way round? All your strategy, planning, efforts, and capital go for a toss. I'm certain this is one situation all of us have been in. In fact, this is one of the reasons why most professional traders go beyond the regular directional bets and set up strategies which are insulated against the unpredictable market direction. Strategies whose profitability does not really depend on the market direction are called market neutral or delta neutral strategies. Over the next few chapters we will understand some of the market neutral strategies and how a regular retail trader can execute such strategies. Let us begin with a long straddle. 10.2 Long Straddle. Long straddle is perhaps the simplest market-neutral strategy to implement. Once implemented, the P&L is not affected by the direction in which the market moves. The market can move in any direction, but it has to move. As long as the market moves, irrespective of its direction, a positive P&L is generated. To implement a long straddle, all one has to do is buy a call option, buy a put option, ensure both the options belong to the same underlying, both the options belong to the same expiry, belong to the same strike. Here is an example which explains the execution of a long straddle and the eventual strategy payoff. As I write this, the market is trading at 7,579, which would make the strike 7,600 at the money. Long straddle would require us to simultaneously purchase the ATM call and put options. As you can see from the snapshot above, 7600 CE is trading at 77 and 7600 Pay is trading at 88. The simultaneous purchase of both these options would result in a net debit of 165 rupees. The idea here is the trader is long on both the call and put options belonging to the ATM strike. Hence the trader is not really worried about which direction the market would move. If the market goes up, the trader would expect to see gains in call options far higher than the loss made read premium paid on the put option. Similarly, if the market goes down, the gains in the put option far exceeds the loss on the call option. Hence, irrespective of the direction, the gain in one option is good enough to offset the loss in the other and still yield a positive P&L. Hence, the market direction here is meaningless. Let us break this down further and evaluate different expiry scenarios. Scenario 1: market expires at 7,200. Put option makes money. This is a scenario where the gain in the put option not only offsets the loss made in the call option but also yields a positive P&L over and above. At 7,200, 7600 CE will expire worthless. Hence we lose the premium paid, i.e. Rs. 77. 7600 Pay will have an intrinsic value of 400. After adjusting for the premium paid, i.e. 88 rupees, we get to retain 400 to 88 equals 312. The net payoff would be 312 to 77 equals plus 235. As you can see, the gain in put option after adjusting for the premium paid for put option and after adjusting for the premium paid for the call option still yields a positive P&L. Scenario 2: market expires at 7,435, lower break-even. This is a situation where the strategy neither makes money nor loses any money. 7600 CE would expire worthless. Hence the premium paid has to be written off. Loss would be 77 rupees. 7600 Pay would have an intrinsic value of 165. Hence this is the gain in the put option. However, the net premium paid for the call and put option is 165 rupees, which gets adjusted with the gain in the put option. If you think about it, with respect to the ATM strike, market has indeed expired at a lesser value, so therefore the put option makes money. However, the gains made in the put option adjusts itself against the premium paid for both the call and put option, eventually leaving no money on the table. Scenario 3: market expires at 7,600 at the ATM strike at 7,600. The situation is quite straightforward, as both the call and put option would expire worthless and hence the premium paid would be gone. The loss here would be equivalent to the net premium paid, i.e. 165 rupees. Scenario 4: market expires at 7,765, upper break-even. This is similar to the second scenario we discussed. This is a point at which the strategy breaks even at a point higher than the ATM strike. 7600 CE would have an intrinsic value of 165. Hence this is the gain in call option. 7600 Pay would expire worthless. Hence the premium paid towards the option is lost. The gain made in the 7600 CE is offset against the combined premium paid. Hence the strategy would break even at this point. Scenario 5: market expires at 8,000. Call option makes money. Clearly the market in this scenario is way above the 7,600 ATM mark. The call option premiums would swell, so much so that the gains in call option will more than offset the premiums paid. Let us check the numbers. 7,600 Pay will expire worthless. Hence the premium paid, i.e. 88 rupees, is to be written off. At 8,000, The 7600 CE will have an intrinsic value of 400. The net payoff here is 488.77 equals plus 235. So as you can see, the gain in call option is significant enough to offset the combined premiums paid. Here is the payoff table at different market expiry levels. As you can observe, the maximum loss 165 occurs at 7,600, which is the ATM strike. The profits are unlimited in either direction of the market. We can visualize these points in the payoff structure here from the V-shaped payoff graph. The following things are quite clear. With reference to the ATM strike, the strategy makes money in either direction. Maximum loss is experienced when markets don't move and stay at ATM. Max loss equals net premium paid. There are two break-evens on either side, equidistant from ATM. Upper break-even equals ATM plus net premium. Lower break-even equals ATM net premium. I'm certain you find this strategy quite straightforward to understand and implement. In summary, you buy calls and puts. Each leg has a limited downside. Hence the combined position also has a limited downside and an unlimited profit potential. So in essence, a long straddle is like placing a bet on the price action each way. You make money if the market goes up or down. Hence the direction does not matter here. But let me ask you this, if the direction does not matter, what else matters for this strategy? 10.3 Volatility matters. Yes, volatility matters quite a bit when you implement the straddle. I would not be exaggerating if I said that volatility makes or breaks the straddle. Hence a fair assessment on volatility serves as the backbone for the straddle's success. Have a look at this graph below. The y-axis represents the cost of the strategy, which is simply the combined premium of both the options, and the x-axis represents volatility. The blue, green, and red line represents how the premium increases when the volatility increases, given that there is 30, 15, and 5 days to expiry respectively. As you can see, this is a linear graph and irrespective of time to expiry. The strategy cost increases as and when the volatility increases. Likewise, the strategy costs decreases when the volatility decreases. Have a look at the blue line. It suggests when volatility is 15%. The cost of setting up a long straddle is 160. Remember, the cost of a long straddle represents the combined premium required to buy both call and put options. So at 15% volatility it costs 160 rupees to set up the long straddle. However, keeping all else equal, when volatility increases to 30% it costs 340 rupees to set up the same long straddle. In other words, you are likely to double your money in the straddle provided you set up the long straddle at the start of the month. The volatility at the time of setting up the long straddle is relatively low. After you set up the long straddle, the volatility doubles. You can make similar observations with the green and red line, which represents the price to volatility behavior when the time to expiry is 15 and 5 days respectively. Now, this also means you will lose money if you execute the straddle when the volatility is high, which starts to decline after you execute the long straddle. This is an extremely crucial point to remember. At this point, let us have a quick discussion on the overall strategy's delta. Since we are long on ATM strike, the delta of both the options is close to 0.5. The call option has a delta of plus 0.5. The put option has a delta of 0.5. The delta of call option offsets the delta of put option, thereby resulting in a net zero overall delta. Recall, delta shows the direction bias of the position. A plus V delta indicates a bullish bias and V delta indicates a bearish bias. Given this, a zero delta indicates that there is no bias whatsoever to the direction of the market. So all strategies which have zero deltas are called delta neutral and delta neutral strategies. Are insulated against the market direction. 10.4 What can go wrong with the straddle? On the face of it, a long straddle looks great. Think about it, you get to make money whichever way the market decides to move. All you need is the right volatility estimate. Therefore, what can really go wrong with a straddle? Well, two things come in between you and the profitability of a long straddle. Theta decay, all else equal. Options are depreciating assets, and this particularly hurts long positions. The closer you get to expiration, the lesser time value of the option. Time decay accelerates exponentially during the last week before expiration. So you do not want to hold on to out-of-the-money or at-the-money options into the last week and lose premiums rapidly. Large break-evens, recollect. In the example we discussed earlier, the break-even points were 165 points away from the ATM strike. The lower break-even point was 7,435 and the upper break-even was 7,765. Considering the ATM strike was 7,600. In percentage terms, the market has to move 2.2% either ways to achieve break-even. This means that from the time you initiate the straddle, the market or the stock has to move at least 2.2% either ways for you to start making money. And this move has to happen within a maximum of 30 days. Further, if you want to make a profit of at least 1% on this trade, then we are talking about a 1% move over and above 2.2% on the index. Such large move on the index is quite a challenge in my opinion, and I will explain why in the next chapter. Keeping the above 2 points plus the impact on volatility in perspective, we can summarize what really needs to work in your favor for the straddle to be profitable. The volatility should be relatively low at the time of strategy execution. The volatility should increase during the holding period of the strategy. The market should make a large move. The direction of the move does not matter. The expected large move is time-bound. Should happen quickly, well within the expiry. From my experience trading long straddles, they are profitable when set up around major market events, and the impact of such events should exceed over and above what the market expects. Let me explain the event and expectation part a bit more. Please do read the following carefully. Let us take the Infosys results as an example here. Event: quarterly results of Infosys expectation muted to flat revenue guideline for the coming few quarters. Actual outcome: as expected, Infosys announces muted to flat revenue guideline for the coming few quarters. If you were to set up a long straddle in the backdrop of such an event and its expectation, and eventually the expectation is matched, then chances are that the straddle would fall apart. This is because around major events, volatility tends to increase, which tends to drive the premium high. So if you were to buy a TM call and put options just around the corner of an event, then you are essentially buying options when the volatility is high. When events are announced and the outcome is known, the volatility drops like a ball, and therefore the premiums. This naturally breaks the straddle down, and the trader would lose money owing to the bought at high volatility and sold at low volatility phenomena. I've noticed this happening over and over again, and unfortunately have seen many traders lose money exactly for this reason. Favorable outcome, however, imagine instead of muted to flat guideline they announce an aggressive guideline. This would essentially take the market by surprise and drive premiums much higher, resulting in a profitable straddle trade. This means there is another angle to straddles. Your assessment of the event's outcome should be a couple of notches better than the general market's assessment. You cannot set up a straddle with a mediocre assessment of events and its outcome. This may seem like a difficult proposition, but you will have to trust me here. Few quality years of trading experience will actually get you to assess situations way better than the rest of the market. So, just for clarity, I'd like to repost all the angles which need to be aligned for the straddle to be profitable. The volatility should be relatively low at the time of strategy execution. The volatility should increase during the holding period of the strategy. The market should make a large move. The direction of the move does not matter. The expected large move is time-bound. Should happen quickly, well within the expiry. Long straddles are to be set around major events, and the outcome of these events to be drastically different from the general market expectation. You may be wondering, there are far too many points that come in between you and the long straddle's profitability. But worry not. I'll share an antidote in the next chapter, the short straddle, and why it makes sense. Download the Long Straddle Excel. Key takeaways from this chapter. Strategies which are insulated to market direction are called market neutral or delta neutral. Market neutral strategies such as long straddle makes money either which way the market moves. Long straddle requires you to simultaneously buy the ATM call and put option. The options should belong to the same underlying, same strike, and same expiry. By buying the CE and pay, the trader is placing the bet on either direction. The maximum loss is equal to the net premium paid, and it occurs at the strike at which the long straddle has been initiated. The upper break-even is strike plus net premium. The lower break-even is strike net premium. The deltas in a long straddle adds up to 0. The volatility should be relatively low at the time of strategy execution. The volatility should increase during the holding period of the strategy. The market should make a large move. The direction of the move does not matter. The expected large move is time-bound. Should happen quickly, well within the expiry. Long straddles are to be set around major events, and the outcome of these events to be drastically different from the general market expectation. 100. Open a ZERODHA account. Chapter 11. The Short Straddle. 11.1 Context. In the previous chapter we understood that for the long straddle to be profitable, we need a set of things to work in our favor. Reposting the same for your quick reference. The volatility should be relatively low at the time of strategy execution. The volatility should increase during the holding period of the strategy. The market should make a large move. The direction of the move does not matter. The expected large move is time-bound. Should happen quickly, well within the expiry. Long straddles are to be set up around major events, and the outcome of these events to be drastically different from the general market expectation. Agreed that the directional movement of the market does not matter in the long straddle, but the bargain here is quite hard, considering the 5 points list. Getting the long straddle to work in your favor is quite a challenge, recall. In the previous chapter the breakdown was at 2%. Add to this another 1% as desired profits and we are essentially looking for at least a 3% move on the index. From my experience, expecting the market to make such moves regularly is quite a challenge. In fact, for this reason alone, I think twice each and every time I'd need to initiate a long straddle. I have witnessed many traders recklessly set up long straddles thinking they are insulated to the market's directional movement. But in reality they end up losing money in a long straddle. Time delay in the general movement in the market, or the lack of it, works against them. Please note, I'm not trying to discourage you from employing the long straddle. No one denies the simplicity and elegance of a long straddle. It works extremely well when all the 5 points above are aligned. My only issue with long straddle is the probability of these 5 points aligning with each other. Now think about this, there are quite a few factors which prevents the long straddle to be profitable. So as an extension of this, the same set of factors should favor the opposite of a long straddle, i.e. the short straddle. 11.2 The short straddle. Although many traders fear the short straddle as losses are uncapped, I personally prefer trading the short straddle on certain occasions over its pure strategies. Anyway, let us quickly understand the setup of a short straddle and how its P&L behaves across various scenarios. Setting up a short straddle is quite straightforward as opposed to buying the ATM call and put options. Like in long straddle, you just have to sell the ATM call and put option. Obviously, the short strategy is set up for a net credit, as when you sell the ATM options, you receive the premium in your account. Here is any example. Consider Nifty is at 7,589. So this would make the 7,600 strike ATM. The option premiums are as follows. 7,600 CE is trading at 77. 7,600 pay is trading at 88. So the short straddle will require us to sell both these options and collect the net premium of 77 plus 88 equals 165. Please do note the options should belong to the same underlying, same expiry, and of course same strike. So assuming you have executed this short straddle, let's figure out the P&L at various market expiry scenarios. Scenario 1, market expires at 7,200. We lose money on put option. This is a scenario where the loss in the put option is so large that it eats away the premium collected by both the CE and pay, resulting in an overall loss. At 7,200, 7,600 CE will expire worthless. Hence we get the retain the premium received, i.e. 77. 7,600 pay will have an intrinsic value of 400. After adjusting for the premium received, i.e. 88 rupees, we lose 400 to 88 equals 312. The net loss would be 312 to 77 equals 235. As you can see, the gain in call option is offset by the loss in the put option. Scenario 2, market expires at 7,435. Lower breakdown. This is a situation where the strategy neither makes money nor loses any money. 7,600 CE would expire worthless. Hence the premium received is retained. Profit here is 77 rupees. 7,600 pay would have an intrinsic value of 165, out of which we have received 88 rupees as premium. Hence our loss would be 165 to 88 equals minus 77. The gain in the call option is completely offset by the loss in the put option. Hence we neither make money nor lose money at 7,435. Scenario 3, market expires at 7,600 at the ATM strike. Maximum profit. This is the most favorable outcome for a short straddle. At 7,600. The situation is quite straightforward as both the call and put option would expire worthless and hence the premium received from both the call and put option will be retained. The gain here would be equivalent to the net premium received, i.e. 165 rupees. So this means, in a short straddle you make maximum money when the markets don't move. Scenario 4, market expires at 7,765. Upper breakdown. This is similar to the second scenario we discussed. This is a point at which the strategy breaks even at a point higher than the ATM strike. 7,600 CE would have an intrinsic value of 165. Hence after adjusting for the premium received of Rs. 77. We stand to lose 88 rupees, 165 to 77. 7,600 pay would expire worthless. Hence the premium received, i.e. 88 rupees, is retained. The gain made in the 7,600 pay is offset against the loss on the 7,600 CE. Hence we neither make money nor lose money. Clearly this is the upper breakdown point. Scenario 5, market expires at 8,000. We lose money on call option. Clearly the market in this scenario is way above the 7,600 ATM mark. The call option premium would swell. So would the loss. 7,600 pay will expire worthless. Hence the premium received, i.e. 88 rupees, is retained. At 8,000, the 7600 CE will have an intrinsic value of 400. Hence, after adjusting for the premium received of Rs. 77, we stand to lose Rs. 323,400 to 77. We have received 88 rupees as premium for the put option. Therefore, the loss would be 88 to 323 equals minus 235. So as you can see, the loss in the call option is significant enough to offset the combined premiums received. Here is the payoff table at different market expiry levels. As you can observe, the maximum profit 165 occurs at 7,600, which is the ATM strike. The strategy remains profitable only between the lower and higher breakdown numbers. The losses are unlimited in either direction of the market. We can visualize these points in the payoff structure here. From the inverted V-shaped payoff graph, the following things are quite clear. The point at which you can experience maximum profits is at ATM. The profits shrink as you move away from the ATM mark. The strategy is profitable as long as the market stays within the breakdown points. Maximum loss is experienced when markets move further away from the breakdown point. The further away the market moves from the breakdown point, higher the loss. Max loss equals unlimited. There are two breakdown points on either side, equidistant from ATM. Upper breakdown equals ATM plus net premium. Lower breakdown equals ATM net premium. As you may have realized by now, the short straddle works exactly opposite to the long straddle. Short straddle works best when markets are expected to be in a range and not really expected to make a large move. Many traders fear short straddle considering the fact that short straddles have unlimited losses on either side. However, from my experience, short straddles work really well if you know how exactly to deploy this. In fact, in the last chapter of the previous module, I had posted a case study involving short straddle. Probably that was one of the best examples of when to implement the short straddle. I will repost the same again here and I hope you will be able to appreciate the case study better. 11.3 Case Study Repost from previous module. The following case study was a part of Module 5, Chapter 23. I'm reposting the same here as I assume you would appreciate the example better at this stage. To get the complete context, I'd request you to read the chapter. Infosys was expected to announce their Q2 results on the 12th of October. The idea was simple: news drives volatility up. So short options with an expectation that you can buy it back when the volatility cools off. The trade was well planned and the position was initiated on the 8th of October, 4 days prior to the event. Infosys was trading close to 1,142 rupees per share. So he decided to go ahead with the 1140 strike ATM. Here is the snapshot at the time of initiating the trade. On the 8th of October around 10:35 a.m. the 1140 CE was trading at 48 and the implied volatility was at 40.26%. The 1140 pay was trading at 47 and the implied volatility was at 48%. The combined premium received was 95 per lot. Market's expectation was that Infosys would announce fairly decent set of numbers. In fact, the numbers were better than expected. Here are the details. For the July to September quarter, Infosys posted a net profit of $519 million, compared with $511 million in the year-ago period. Revenue jumped 8.7% to $2.39 billion. On a sequential basis, revenue grew 6%, comfortably eclipsing market expectations of 4 to 4.5% growth. In rupee terms, net profit rose 9.8% to 3,398 crore rupees on revenue of Rs. 15,635 crore, which was up 17.2% from last year. Source: Economic Times. The announcement came in around 9:18 a.m. 3 minutes after the market opened. And this trader did manage to close the trade around the same time. Here is the snapshot. The 1140 CE was trading at 55 and the implied volatility had dropped to 28%. The 1140 pay was trading at 20 and the implied volatility had dropped to 40%. Do pay attention to this. The speed at which the call option shot up was lesser than the speed at which the put option dropped its value. The combined premium was 75 per lot, and he made a 20-point profit per lot. 11 for the Greeks. Since we are dealing with ATM options, the delta of both CE and pay would be around 0.5. We could add the deltas of each option and get a sense of how the overall position deltas behave. 7600 CE delta at 0.5. Since we are short, the delta would be minus 0.5. 7600 pay delta at 0.5. Since we are short, the delta would be plus 0.5. Combined delta would be minus 0.5 plus 0.5 equals 0. The combined delta indicates that the strategy is directional neutral. Remember, both long and short straddle as delta neutral. In case of long straddle, delta neutral suggests that the profits are uncapped, and in case of short straddle, the losses are uncapped. Now here is something for you to think about. When you initiate a straddle, you are obviously delta neutral. But as the markets move, will your position still remain delta neutral? If yes, why do you think so? If no, then is there a way to keep the position delta neutral? If you can build your thoughts around these points, then I can guarantee you that your options knowledge is far greater than 90% of the market participants. To answer these simple questions, you will need to step a little deeper and get into second level of thinking. Do post your comments below. You can download the Short Straddle Excel. Key takeaways from this chapter. Short straddle requires you to simultaneously sell the ATM call and put option. The options should belong to the same underlying, same strike, and same expiry. By selling the CE and pay, the trader is placing the bet that the market won't move and would essentially stay in a range. The maximum profit is equal to the net premium paid, and it occurs at the strike at which the long straddle has been initiated. The upper breakdown is strike plus net premium. The lower breakdown is strike net premium. The deltas in a short straddle adds up to 0. The volatility should be relatively high at the time of strategy execution. The volatility should decrease during the holding period of the strategy. Short straddles can be set around major events, wherein before the event, the volatility would drive the premiums up, and just after the announcement, the volatility would cool off, and so would the premiums.